Hi everyone, welcome to the public stock market update. I want to try and do it in two batches of 10 minutes each, so let's jump into it. That's valuations. You're paying $33 for every dollar of future expected profits in Microsoft. The cheapest sectors remain energy, drug manufacturers, healthcare plans, telecom services, and some of the financial services. However, the ones which are skyrocketing ahead are these companies, which are presumably the most expensive based on that valuation metric that you're paying $33 in the case of Microsoft for every dollar of future profits. And that's because valuation alone is not the thing that moves stock prices. For instance, expected future growth does. And that's an important factor, as are multitude of others, which is why we don't look at valuation alone. For those trying to panic you into buying value funds or looking at the valuation and the market being overvalued, they're probably financially illiterate or haven't read anything which has been published in the last 40 years on financial economics. Now, earnings calendars. Anything important coming up this week? No. Where are we in terms of which sectors are doing well? Now, I don't particularly care which sectors do well. I care about which companies are doing well. However, if you were to put your money in utilities, you're about to succeed. I mean, it's like throwing darts at a dartboard. You're just going to hit triple 20s on those. Probably basic materials to a larger extent as well. Maybe energy to some extent, and financials, communications. Now, this is one of the reasons I don't like sector picking, because under communication services comes Alphabet, Meta, and Walt Disney. Really? Because I thought they were technology companies. Apparently not. Everything's a technology company. So sectors don't necessarily give you a good idea. I thought Tesla was a technology company. Apparently not. It's a consumer cyclical company. Oh, okay. As is Amazon. I see a big difference between Tesla and Amazon. So again, these sector names tend to be pretty useless. And those who say, oh, shouldn't we make sure our stocks are diversified across different sectors? Again, probably never read a single piece of financial literature in the last 30 years. So what is important? Well, we want our stocks to be undervalued, because undervalued companies tend to, according to the literature, do better than overvalued ones. Not guaranteed to, but tend to. We want them also to tick the growth box of profit growth, another word for earnings, and revenue growth, another word for sales. And ideally want them to pay some dividend yields. But all these factors are not to be equally weighted. We know from the academic research that value is twice as important as growth, is twice as important as income. We also know from Goldman Sachs Wealth Management and Deutsche Bank Wealth Management, who manage money for the wealthiest people in the world, guess what? Your IFA isn't that guy. That croaky cash return on capital invested is important, and we want these companies to be in the top quartile, because that generates 30% per annum as a basket of stocks. Not every year, not every stock in the basket, but overall for the long term, 30% per annum. So we want to tick those boxes at the very least, even if we dispute whether it's 30 or 20 or 15. We certainly know it's not negative, and high cash return on capital invested doesn't harm companies when combined with undervalued high growth companies with dividend deals. Momentum, Citibank's reports, just look at the research out of, well, I guess you could go with AHL to start off with, if you want to look at that research on why that's important. Sortino and Alpha, as a reminder, Sortino, high average return relative to downside risk is what we want in Alpha. Market goes up, you got more. Market falls, you got more. So all those people who say, oh, I've got wonderful credentials, I can generate Alpha through all their stories about their universities and all their education, absolute BS, because Alpha is a statistical measure and you can just look at the historic data. Now, history doesn't guarantee the future. However, as you can pretty much guess, Microsoft's share price tomorrow is not guaranteed to go up or down, but it's pretty much guaranteed to stay within a certain range. Got it? Doesn't guarantee the future, but it offers a pretty bloody good guide towards it. And the same goes for any other stock. So Alpha is a statistical measure based upon historic stock prices over the recent past, and we just look for companies with Alpha and we attribute that to our skill. It isn't our skill. Just like me driving a Ferrari isn't me being incredibly skillful of getting from 0 to 100 in 3.2 seconds or whatever it is. It's the car. not the person behind the wheel. Similarly, alpha was the data, wasn't me. How have things been over the past week? Well, Microsoft shot up again, Apple, and I'll come to that in a second. Eli Lilly's up there, Broadcom, Nvidia. It's really been those once again, with the exception of Eli Lilly, which I think should move into this area, technology, don't you? Semiconductors, fantastic. Software applications, bit mixed, but not too bad. Not really much else happening. I guess you could look at home improvements and lodging market. Are you really going to do that? Tesla? Okay, we'll come to that in a second as well. But really all the action is in this corner. Not even in the undervalued financials or the undervalued energy companies, despite all the problems in the Middle East. Exchange traded funds, if you want to have a look at those. I'm not going to go into it on this instance, but you can pause this video and have a look at that. All you want. So markets year to date since January. Now here's an important lesson for you. January, you go all excited. You go, oh my word, look at this. Isn't making money so easy? Right up to April. And then it goes back, lose all your money. The markets are composed of the 3Ds. Okay? Delirium when it's going up, despair when you lose everything that you made, and then delirium again if you do it right. Okay? Now, the order in which those Ds are going to appear will vary. If you start here, you'll start with delirium first, then despair, then delirium. But if you start in April, you'll start with despair first, then delirium. And guess what? Despair is going to return. All right? Now, that's just the way it is. People think it goes up in a straight line. Oh, I got the right stock. I must be doing incredibly well. Well, that's 16.35% since the start of the year. Not bad year to date, is it? For your pension, mine, or anybody else's. And that's just if you're tracking the index. Which sectors have been doing well? Well, technology is right back up there. It's not been the leader at any point since January, pretty much. Well, I guess since January, it's not been top dog. So it's first time since January. There's a little bit here in March where it did it. Communications, utilities, financials, industrials. Guess what? I don't care. I don't know. When this horse race started in January, I did not know which sectors are going to be the winning horses and which aren't. The answer to that is not to spray and pray as your IFA wealth manager, fund manager thinks and put a little bit of money into all of them. They're idiots. The answer is to look for good quality companies which, when the market rises, rise more, alpha, and if the market falls, also rise more. And on those 1 or 2 years out of 7 where you should be holding cash, get out of the stock market asset class altogether in those occasions. And do what Warren Buffett so often does, is hold a bucket load of money until you've got the right pick. So, sector diversification is not the answer. It is more spraying and praying. And that's one way you tell if your IFA is an idiot. You just ask them, so how do you look across sectors? If they start using keywords like sector, diversification, don't know which one's going to go up and down, yeah, okay. Even if they're just doing top-down investing, idiots. They're gambling with your money. What about styles or themes, momentum, value? We didn't know growth. We didn't know which one of these styles would do well. So we make sure that we have stocks which are at the intersection of all of those things. They can't just be value companies, can't just be growth, can't just be momentum, can't just be income. They have to be at the intersection of everything and tick every box. Why? Well, if we start off with 10,000 companies and only need to hold about 20 or 15, then why do we need to worry about all the ones we've left out, which may well go up? There might be undervalued companies which are not growing, which suddenly get some Twitter mention and do well, but we don't care. Over the past year, 32% from June last year to June this year, 32% on the NASDAQ. And look again, delirium, despair, delirium, maybe a bit of despair, delirium. All right? If you started here because you thought, I've missed the boat, I've missed the boat, I've missed the boat, you're always going to be missing boats if that's the way you think. And then, of course, you get the despair and then back. So how do we avoid that problem? Well, we generally tend to hold for 12 months and exit if something drops 25% from the peak, but we can come to that later. That's the FTSE 350, the biggest risers. The S&P, I like it, and I continue having my positions in this, leverage and unleveraged. If you're on my program, you'll know what I'm talking about. Watch out for, again, more Ds, drawdown depth and duration to recovery. That's really important. That tells you your risk appetite. Part 2 coming up next.